Good afternoon and welcome everyone to our webinar. We look forward to sharing how we can make your 990 appealing to grantors and donors. Again, my name is Natasha Carr and I'll be your moderator for today's webinar. As Jenna and Cameron are speaking today, I will monitor the chat for any questions that come through. Please feel free to ask questions as we go through the webinar and we will try to address them either as they come in or after we have gone through the presentation in its entirety. Without further ado, I'm going to turn it over to Cameron.
Thank you, Natasha. To kickstart our presentation, I'm going to take you through the basics of the Form 990 itself to give you a good overview and hopefully help you become a little more familiar with it. The first topic I want to go over with you is the filing timeline of the Form 990. The initial due date of the form is always the 15th day of the 5th month following year end. So, for example, an organization that follows the calendar year and has a year end of December 31st has an initial due date of May 15th. Following the same rule, an organization that has a year end of September 30th has an initial due date of February 15th. If this due date happens to fall on a weekend or legal holiday, the due date would then be delayed until the next business day that immediately follows. For example, if the 15th falls on a Saturday, the due date would be the following Monday as long as it is not a legal holiday. Now, it is possible and common to submit an extension to file if your return is or will not be ready by your initial due date. By filing Form 8868, you are allowed an extension of 6 months from the initial due date of your return. For example, an organization who follows a year end of December 31st and has an initial due date of May 15th that files the Form 8868 would now have a new and extended due date of November 15th, 6 months after May 15th. The same rule that was previously touched on about if the due date falls on a weekend or legal holiday would also apply here with the extended due date. A couple important things to note as well. It is not possible to extend your due date past the 6 months allowed by filing the Form 8868. In other words, once the Form 8868 has been filed, your extended due date is absolute and your return must be filed by that date. Secondly, if your organization also files a 990T, then a separate 8868 would have to be filed for that, possibly with payment. We'll talk a little bit more about that later on in the presentation. A couple special considerations we also want to go over include the initial year and possible short year. If it is your first or initial year, your organization must be filing a complete Form 990 if either of the following apply. Number one, your gross receipts for the year are greater than or equal to $200,000, or number two, your total assets are greater than or equal to $500,000 at the end of the tax year. If you do not meet these thresholds, then your organization would most likely be filing a 990EZ or 990N postcard, depending on the circumstances. There are, as always, exceptions to this. However, for the sake of time, we are only going to go over the Form 990 today. It is also possible that your organization would need to file a short year return. The short tax period is just an accounting period of less than 12 months. It would most likely occur either when an organization begins operations, has a change in their accounting period, or terminates. For an example, we will focus on an organization that needs to file a short year in the event they change their accounting period. Let's say the organization operates on a December 31st year end, but would like to switch to a September 30th year end. The organization would begin by filing a short year return for January 1st through September 30th. Then the succeeding return would then cover the period beginning October 1st through 12 months to September 30th, and then continue to file for that period moving forward thereafter. Moving on, now we would like to dive into the Form 990 and give you a high-level overview on what is reported on the return itself and how things may be presented. Beginning with Part 1 of the Form 990 on page 1, which is essentially a summary of the return. This information reported here is simply pulled from all other parts of the return that follow. Because of that, we won't go into too much depth here, and instead move on to go into a little more detail of the parts that follow. Part 2 on the bottom of page 1 is simply the signature block, so we don't need to spend any time there. Part 3, which can be found on page 2 of the Form 990, is where the mission statement is presented along with the descriptions of the organization's 3 largest program service accomplishments. If an organization would like to provide descriptions for additional program service accomplishments, on top of those three largest, it may do so, and those additional descriptions would then be listed with the Schedule O disclosures, which we will discuss a little later. Along with these descriptions, you will notice that there is a line to list out the revenue expenses associated with your accomplishments. It is important to note that your program service revenue and program service expenses must be allocated between the provided program service accomplishments listed here. I will point out where those amounts are as we go over the revenue and expenses sections. We would really like to highlight Part 3 here because it is a great opportunity for the organization to boast about itself and its programs to potential donors and grantors. More often than not, this section is underutilized, with generic and short descriptions that don't tell a story of what the organization is all about. Remember, the Form 990 is a public document, so we would highly suggest that you use this section to really brag and show potential donors and grantors the impact you make within your respective communities. Moving on to Part 4, the checklist of required schedules. This section is a series of questions that ultimately, as the name suggests, lets you know what accompanying schedules should be completed and filed with your return. If you go through and take a closer look, it will tell you exactly what you need to file based on your answers given. It may be beneficial to take some time and do a quick review of these questions each year, in case you think some questions should be answered differently. Sometimes your CPA may not be privy to any and all new activity undertaken throughout the year, so things could potentially be missed. However, in most cases, these questions will be answered the same year to year. Just for an idea, there are a total of 16 schedules that will have the potential to be necessary and completed to file with your return. However, many of these are uncommon, and we do not see them much. I do want to highlight a few of the most common schedules for you. Some of the most common schedules filled out include Schedule A, the public support test, Schedule B, the list of contributors, Schedule D, the supplemental financial statements, Schedule G, supplemental information regarding fundraising or gaming activities, and Schedule O, the disclosures. We will go over a few things about each of those schedules a little later on in the presentation. Part 5, statements regarding IRS filings and tax compliance. This section is where other IRS filings, such as Form W-2, Form W-2Gs, and Form 1099s that the organization has filed are reported. Essentially, this is where the organization answers questions to ensure that they are in compliance with all their other IRS filings. This is an area that needs to be monitored closely, as it is one of the most common areas in which the IRS would collect money due to steep penalties. Always make sure to be in communication with your CPA on these items to make sure that you are in compliance and filed everything necessary as to avoid being in danger of these penalties. Next, on Part 6, the form goes over the governance, management, and disclosures. I will move on to Part 7 for now, as Jenna will be going over Part 6 a little later on in the presentation in more detail. Part 7, Section A, is where the Board of Directors is reported. On top of that, any compensation received by anyone on the Board of Directors, officers, and trustees is reported here as well. Other individuals do have the potential to meet requirements to be listed here. Those individuals would be those who meet the requirements to be considered a key employee or highest compensated employee. For an example, if an employee of the organization has compensation received by the organization of at least $100,000, but it is not on the Board of Directors, they would still be listed here on Part 7, Section A, as they have met the requirements to be considered a highly compensated employee. This section of the reporting requirements can be tricky to navigate, so we would be happy to answer any questions you may have. Section B of Part 7 is where any independent contractors who have been compensated more than $100,000 for their services would be reported. Moving on to Parts 8, 9, and 10, this is where we get into the financial statement reporting of revenue, expenses, and balance sheet items. Starting with Part 8, this is the statement of revenues and is prepared using the statement of activities on your financial statements. The revenue reporting is broken out into 4 major sections, which can be seen on the left side of the page and are contributions, gifts, grants, etc., program service revenue, other revenue, and miscellaneous revenue, allocated between 3 categories. Those categories can be seen at the top, and they are Column B, related or exempt function revenue, Column C, unrelated business revenue, which Jenna will talk about later, and Column D, revenue excluded under Sections 512 through 514. I will not be going into more detail about the 3 columns today, but thought they were important enough to note for now. There are a couple things in this section that I think are important to point out, such as line 12, column B. This is the total of your related revenue and the amount that should be allocated between the program service accomplishment descriptions found on page 2, part 3, that I had spoken about earlier. Lines 8 and 9 should also tie to Schedule G if applicable to your organization. We will talk about Schedule D more in depth soon. The total revenue must tie to Schedule D if completed by organization and ultimately the financial statements. Part 9 is the Statement of Functional Expenses and is prepared using the Statement of Functional Expenses on your financial statements. A majority of the time, these expenses are allocated between the 3 categories found at the top of this page. We will get more into the purpose of this allocation a little later on. For now, it is important to note that the total program service expenses found on line 25, column B, is the amount that should be allocated between the program service accomplishment descriptions found on page 2, part 3. Just like the revenue, this total should tie to Schedule D, if applicable, as well as your financial statements. Part 10 is simply the balance sheet items prepared using the balance sheet from your financial statements. There's not much of importance to note here. Parts 11 and 12 go over additional supplemental information regarding the financial statements. Part 11 is a reconciliation of net assets. It is a simple calculation to make sure your end of year net assets, according to your tax return, ties to the end of year net assets according to your financial statements. If line 10 of part 11 does not tie to line 32 on part 10, a prior period adjustment may need to be made. Some other items on this reconciliation may include the reporting of unrealized gains or losses and donated services and use of facilities, which are not reportable on parts 8 or 9. Part 12 includes some additional information, such as your accounting method and whether that has changed during the year, as well as whether your financial statements underwent a compilation, review, or audit with the questions found on lines 2A and 2B. Line 3A touches on whether your organization was required to undergo a required audit set forth in the uniform guidance. After parts 1 through 12 of your Form 990, the schedules will then be presented in alphabetical order. Because there are so many different schedules that cover a ton of different information, I will focus on a couple of the most common ones so that you are familiar with them. Schedule A is the public support test and is ultimately a calculation to make sure you are truly publicly supported. Which parts you fill out are determined by the type of organization you are, which is found on your IRS determination letter. For the sake of time, there are just a couple of things that I wanted to highlight on Schedule A. Regardless of which part you are instructed to complete, the public support percentage calculation is in Section C and is required to be above 33.3%. It is a good idea to keep an eye on this percentage from year to year to make sure it is being maintained. If it falls beneath this percentage, you may be in an area in which you are required to switch to a private foundation. Schedule B, List of Contributors, is a simple schedule where your list of contributors is reported. Depending on the part of Schedule A that is completed, this could either be all contributors who contributed an aggregate of at least $5,000 or all contributors who contributed over a certain threshold. This threshold would simply be $5,000 or 2% of the total contributions received during the year, which can be found on Part 8, line 1H. Schedule D and O are very common schedules to fill out, but I do not believe there's anything important enough that we need to highlight and talk about at the moment. To close out this portion of the presentation on the overview of the preparation of Form 990, I thought it may be helpful to include a list of items that I request from clients each year to get the ball rolling on the preparation of their return. These items include the number of volunteers that serve the organization. This does not have to be an exact number and can be an estimate. The applicable Form W-3 or number of W-2s filed during the year. The applicable Form 1096 or number of 1099s filed during the year. If any of these 1099s report over $100,000 in compensation, we would then need a copy of that specifically for reporting of highest compensated contractors on Part 7, Section B. updated narratives for page 2, part 3, program service accomplishments, a copy of the current financial statements, and a list of contributors if applicable based on the reporting rule that was touched upon earlier. Of course, as every client is different, there may be additional items that I request that are unique to their situation, but these are the most common between everyone I work with.
And we're at our first polling question. As a reminder, you'll need to answer 3 of these polling questions to get CPE credit. So do you typically extend your 990 or file by the initial due date? A, you extend, B, you don't extend, or C, you file past the deadline? Again, it's do you typically extend your 990 or file by the initial due date? A, extend, B, don't extend, or C, file past the deadline? We'll give everyone a second to answer.
Thanks, Natasha. And you do have to do 3 of the poll questions to qualify for CPE, and I believe there are 5 in this webinar. So if you miss one, just make sure to stay on for another chance to complete one. All right, Natasha, I think we're ready. I think next you hand it over to Jenna.
Yep. Jenna, if you could get us started on the second half, that'd be great.
I sure can. Cameron touched on this earlier, but Part 6 of the 990 is a very useful tool to help your organization appeal to donors. It's the part that focuses on your organization's governance and management, policies, and disclosures. Section A lists a few questions about your governing body and management. I want to highlight a few of the more important ones: voting members, family or business relationships, delegation of control, changes to governing documents, and governance decisions. The first one I want to discuss is voting members. This question asks how many total voting members your organization has and how many of those are independent, which typically means uncompensated. An independent board is especially important to potential donors because it ensures that the board will make impartial decisions, it decreases the potential for problematic conflicts of interest, and it shows a commitment to ethical governance and accountability. Next is to disclose any family or business relationships, which shows potential donors that your organization is transparent. Section A also asks if you have delegated management control to an outside organization or another person. This is not inherently a negative thing, but disclosing it is another way to prove transparency. The next question is where you will let outside parties know if there have been any amendments or other changes to your bylaws or other governing documents. Finally, you will let readers know whether or not you have a designated committee to review the 990 before filing. This shows you are committed to being accurate, transparent, and accountable. Section B is where you can discuss the policies you have in place. This includes your conflict of interest policy, whistleblower policy, document retention and destruction policy, and any joint ventures you may be involved in. Policies are important because they provide a clear framework for how tasks should be performed, ensuring that everyone in the organization follows the same procedures, and they ensure that everyone is treated consistently and fairly. They also outline the expectations for behavior and performance, making it clear what is required from staff, volunteers, and board members. Clear policies also help ensure that the organization complies with federal, state, and local laws and regulations, such as those related to employment, fundraising, and financial reporting. Policies are the backbone of a nonprofit's governance and operational framework. They provide structure, ensure compliance, promote transparency, and protect the organization's integrity and reputation. By implementing and adhering to well-defined policies, nonprofits can operate more effectively, maintain public trust, and achieve their mission more efficiently. Section C is where you list how donors can find your public-facing documents and whether or not they can find or request your governing documents, policies, and/or financial statements. Form 990 also requires organizations to provide detailed information about their expenses, including a functional expense allocation. This allocation categorizes expenses based on their function, helping to show how resources are used to achieve the organization's mission. Functional expense allocation is primarily reported on Part 9 of Form 990, which is called the Statement of Functional Expenses. It is broken down into 3 columns: program services, management in general, and fundraising. Expenses that go in the program services column are expenses directly related to carrying out the organization's mission. This includes costs for activities, programs, and services that fulfill your organization's primary objectives. Management and general expenses are the expenses necessary for the overall administration and operation of your organization, but not necessarily directly related to the specific programs or fundraising activities. Examples include salaries of the executive staff, accounting and legal services, office management, and general administrative expenses. Fundraising expenses are those incurred in soliciting contributions, grants, and other financial support. This includes costs associated with fundraising campaigns, events, and activities aimed at obtaining donations. This section delivers transparency by providing donors, regulators, and the public with a clear understanding of how your organization allocates its resources. It provides accountability by demonstrating your organization's commitment to ethical and efficient use of funds, and ensures compliance to meet the IRS or regulations for your grants and reporting expenses, and assists with overall decision making by helping the organization's leadership make informed decisions about budgeting and resource allocation. Essentially, by accurately reporting functional expenses, organizations can show how effectively they are using their resources to fulfill their mission and meet their goals. Part 9 is a great way to appeal to donors and grantors because it can help organizations build public trust by clearly demonstrating how funds are used. Donors also want to ensure that their contributions are being used effectively. Detailed functional expense reporting reassures them and shows their money is going to the right place. Allocating expenses in a nonprofit organization can be done several different ways. The following methods are a few ways to help ensure that the expenses are accurately attributed to the appropriate categories. The first is direct allocation, which directly assigns expenses to the appropriate category based on the specific purpose of that expense. Then there is time study, which means having employees track the time they spend on different activities. Then you allocate the expenses based on the amount of time spent in each functional area. There's also usage-based allocation, where you allocate expenses based on the actual uses of resources or services. Next is revenue-based allocation, where you allocate expenses based on the revenue generated or the budget allocated for each functional area. You can use any of these, a combination, or something else, whatever helps capture your organization's expenses the best. In my experience, the most common have been direct and time study. You will want to apply the same allocation methods consistently over time to allow for comparability, but you also want to regularly review your allocation methods and assumptions to ensure that they remain accurate. Also, keep detailed records of allocation methods and the rationale behind them to provide transparency and support for audits. By using these methods, nonprofit organizations can ensure that their expenses are allocated accurately, reflecting the true cost of their various activities and functions. The next item I want to discuss are special event expenses. Special event expenses in a nonprofit organization are reported on Form 990 in a manner that clearly differentiates between the costs of conducting the event and the contributions received from it. This means they get reported in a few different places on the 990. On Part 8, you will report the total amount received from ticket sales, sponsorships, auctions, and other revenue-generating activities associated with the event, as well as all costs directly attributable to the event, such as the venue rental, catering, entertainment, printing, or mailing of invitations. These expenses are typically reported separately from other fundraising expenses to provide a clear picture of the net revenue from that specific event. On Part 9, you will allocate indirect costs related to the planning and execution of special events, such as salaries of staff involved in organizing the event, to the fundraising column. Indirect expenses might include marketing, administrative support, and other overhead costs that support the event. You will report the specific event on the Schedule G, Part 2. This is where you will provide detailed information about each significant special event, including the name of the event, gross receipts, contributions, and direct expenses broken out into the following categories: cash prizes, non-cash prizes, rent and facility costs, food and beverage, entertainment, and all other direct costs. One item to note is that you will separately list your 2 largest fundraising events in their own columns on the Schedule G, and then combine the rest into one column. One tricky item to report is the direct benefit to donors. A direct benefit to donors refers to the tangible goods or services that a nonprofit organization provides to donors in exchange for their contributions during fundraising events. These benefits can include meals, entertainment, merchandise, or other items given as part of the special event. When reporting on a 990, it's important to accurately distinguish between the portion of contributions that are tax deductible to the donor and the value of benefits received by the donors, which are not tax deductible. For example, a donor pays $200 to attend a gala. The cost of food and entertainment included with the ticket is $50. Therefore, the contribution to the organization is $150. This contribution will show up on both Part 8, Line 1 and Schedule G. Something else to keep in mind about the Schedule G is that most organizations will want to avoid reporting a loss if possible. Typically, the contribution should more than cover the costs of the fundraiser. Since the contribution is tax deductible for the donor, you will want to make sure that you are capturing the fair market value of the contribution. And if there's a loss, the contribution might not be deductible at all. Accurate reporting of special event expenses ensures transparency, allowing donors and other participants to see how effectively the organization uses its resources. Proper reporting is essential for compliance with IRS regulations, helping to maintain the organization's tax-exempt status. By clearly separating the costs and revenues of special events, the organization can better analyze the success and efficiency of its fundraising efforts. All of this together provides a clear picture of the direct impact of an organization's fundraising events.
Okay, we are at our second polling question. Which schedule do you have the most questions? Is it A, Schedule G, B, Schedule C, C, another schedule, D, all schedules, or E, no schedules? Again, which schedule do you have the most questions? Is it A, Schedule G, B, Schedule C, C, another schedule, D, all schedules, or E, no schedules? Again, we'll give you just a second. And Jenna, if you want to go ahead and get started.
I think Cameron is next for this section.
Thank you.
So there are many common errors that I have located and corrected when onboarding new clients, and I wanted to highlight a few of those for you today. The first of those potential errors would be if your organization reports on a fiscal year that is not a calendar year end of December 31st. This would give rise to some reporting differences in compensation for directors and officers between Part 7 and Part 9. The compensation on Part 7 would be reported on a December 31st year-end basis. This is based on the Form W-2 or 1099 filed for them. The Form W-2 or 1099 year used would depend on the year in which the fiscal year started for that organization. For example, if this is for a return with the year ended September 30th, 2023, the compensation reported for an officer on Part 7 would be based on the 2022 Form W-2 because the fiscal year started on October 1st, 2022. The reporting on Part 9 would be on a fiscal year basis, and the compensation reported for an officer here would be for the time period between October 1st, 2022 and September 30th, 2023, following the same example above. Similarly, the reporting of the number of W-2s filed or the number of 1099s filed would follow the same process. It would depend on the calendar year in which your fiscal year began. So, in the case of a return ended September 30th, 2023, the 2022 Form W-3 and 2022 Form 1096 would be used in the number of filings reported on page 1. Other potential errors can be found on parts 12 and Schedule D. On Part 12, it is important to have the correct option for line 2 checked on whether your organization received your financial statements via compilation, review, or audit if applicable. On Schedule D, if your financial statements were audited, it is important that parts 11 and 12 on Schedule D tie back to your financial statements. Some common items that are missed in the reconciliation piece here include unrealized gains or losses, donated services and use of facilities, as well as expenses that may have been moved from Part 9 to Part 8 for things such as fundraising event reporting. On Schedule A, it is very important to keep records and a calculation of excess contributors and payments received from disqualified persons, as this will affect your public support test and can do so negatively, so it is important to plan here if need be. Schedule O is a common place for spelling and grammatical errors since it is the last part of the return. Things such as misspellings, missing spaces, and grammatical errors could be seen by potential donors and grantors. It is also important to make sure the processes listed here are up to date. I often see an organization report that they have 0 volunteers on the page 1 summary. This cannot be the case if there are uncompensated board members present. If the organization truly did not have any volunteers, then the number of uncompensated board members would be reported on the page 1 summary. Essentially, the number of uncompensated board members should also be included in the volunteers number if there are others. It is also very important to be aware of your state filing requirements. For this section, I am mainly focusing on Michigan and Ohio, as those are the 2 that I am most familiar with. If you have filing requirements for a different state or are concerned that you may have others you are not currently up to date with, you can send us an email and we can get back to you with an answer or explanation to the best of our abilities. For Michigan, any charitable organization operating within the state of Michigan must file a license to solicit unless they are exempt. This license to solicit, Form CTS-01, is a simple form that requires some attachments of filing and governing documents. Once that is filed, a renewal must be filed each year, which is Form CTS-02. There are, of course, exemptions to this filing, which are listed out in Michigan Form CTS-03. For Ohio, any charitable organization operating within the state of Ohio must register with the AG office and submit an annual report online via the Attorney General website. After the draft of the Form 990 has been completed, usually the next step is to have it approved by the organization. This process of review is usually described on Schedule O and is referenced on lines 11A and 11B on Part 6, Section B. Once the draft is ready, work with your accounting firm to obtain a copy and then disperse it to the necessary board members and officers. This will differ between organizations, who might have it reviewed by everyone on the board, or just a few members such as the executive director or treasurer. I wanted to give you an idea or roadmap of some helpful items to pay attention to when reviewing your own Form 990, as there is an abundance of information to comb through. Some important areas include the page 2, part 3, program service accomplishments, to make sure the narratives are up to date and your standards, and any numbers within them are for the current year. Quickly review questions on part 4, 5, and 6 to make sure that they still apply. Review part 7 specifically to make sure the names are spelled correctly, or if there's a board member listed here who prefers to go by a different name. For example, a board member with the name of Peter may prefer to go by Pete here. Also, you want to make sure that the board titles are up to date. It is always a good idea to scan through your Schedule O disclosures to make sure the processes explained there still apply and are current, and to make sure there are no errors. One last thing I wanted to note would be that it is very important to work with your CPA on any internal due dates you may have. For example, if a large grantor wants a return by a certain date, or if you would like the Form 990 in time for a certain board meeting, this is essential to avoid any last-minute scrambling and allow your CPA time to prepare an accurate tax return.
Our next polling question is, do you prepare your own 990 or have an external preparer? A, you prepare it yourself, or B, it's external. Again, do you prepare your own 990 or have an external preparer? A, you prepare it yourself, or B, you have an external preparer.
And Natasha, we did have a question asking if the webinar is being recorded, and it is being recorded. And later today, attendees will get an email letting them know when the recording is available.
Great, thank you, Carrie. Now we're going to pass it back to Jenna.
I'm going to talk about unrelated business income tax. Unrelated business income tax, or UBIT, is a tax imposed on income generated by tax-exempt organizations from business activities that are not substantially related to their primary exempt purposes. While nonprofit organizations are generally exempt from federal income tax, income from certain activities can be subject to UBIT to ensure that tax-exempt organizations do not have an unfair competitive advantage over for-profit businesses. Form 990-T is used by tax-exempt organizations to report unrelated business income and calculate the tax owed on that income. The form requires detailed reporting of income and expenses associated with unrelated business activities. UBIT is generated from any activity designed to produce income from selling goods or performing services. This activity must be regularly carried on, which means it is done with frequency and continuity. And this activity must be pursued in a manner similar to comparable commercial activities of non-exempt organizations. Finally, it must not significantly contribute to the accomplishment of the organization's exempt purposes, other than through generating income. The following are a few examples of organizations that generate UBIT. A museum that operates a gift shop, which sells items unrelated to its educational mission, such as general souvenirs. A university that runs a bakery that sells baked goods to the general public, and a charity that rents out its parking lot to the public during events when the lot is not needed for its own activities. There are a few exclusions. Passive income, such as dividends, interest, annuities, and certain types of rent and royalties. Activities where substantially all the work is performed by volunteers. Activities carried on primarily for the convenience of members, students, patients, officers, or employees, such as a campus bookstore that sells textbooks, school supplies, and university-branded merchandise to students, faculty, and staff. And income from the sale of merchandise that has been gifted to the organization. There is also an annual event exception. The annual event exception allows the nonprofit to avoid UBIT on income from fundraising activities that are not regularly carried on. These activities must be infrequent and occur on an occasional basis, rather than being a continuous or repeated business activity. The annual event exception allows nonprofits to engage in significant fundraising efforts without being penalized with UBIT, as long as the events are occasional. It helps organizations stay compliant with IRS regulations by properly classifying and reporting fundraising income and expenses, and allows organizations to allocate more resources toward their primary exempt purposes, as funds raised through occasional events are not diminished by UBIT. Some examples are an annual gala or charity auction. The income from ticket sales, auctions, and sponsorships at these events would typically be excluded from unrelated business income, provided the events occur only once a year and are primarily fundraising events. Organizations report their UBIT on Form 990-T, and I will discuss some of the special items to consider when completing your Form 990-T. One thing organizations should keep in mind when reporting UBIT is siloing. Siloing in the context of unrelated business income tax refers to the requirement to separate or silo the income and expenses of different unrelated business activities. The Tax Cuts and Jobs Act of 2017 introduced this siloing requirement, significantly changing how nonprofits report and pay UBIT. This means that each unrelated trade or business activity must be reported and taxed separately rather than aggregating all unrelated business activities into a single calculation. The purpose of this rule is to prevent organizations from using losses from one unrelated business activity to offset the income from another, which could reduce their overall UBIT liability. Organizations cannot combine the income and expenses from multiple unrelated business activities to determine their net taxable income. So losses from one activity cannot be used to offset the income from another, and the UBIT is calculated separately for each unrelated business activity. If an activity generates income, it is taxed. If it generates a loss, that loss is not used to reduce the tax liability from the first activity. Siloing adds complexity to the accounting and reporting processes for nonprofits, as they must maintain detailed records for each unrelated business activity. Also, organizations may face a higher overall UBIT liability since they cannot offset profitable activities with losses from others. Nonprofits must implement proper systems to accurately track income and expenses for each separate unrelated business activity. Siloing is a critical concept for nonprofits to understand and implement in their accounting practices. Unrelated business activities might also generate net operating losses, or NOLs. An NOL occurs when an organization's deductions exceed its gross income from unrelated business activities for a tax year. Essentially, it represents a loss generated from running unrelated business activities. Under the Tax Cuts and Jobs Act, NOLs generated in tax years beginning after December 31, 2017 can be carried forward indefinitely, but you can only offset 80% of taxable income in those years. They must also follow the silo rules discussed earlier. NOLs generated in 2017 and earlier can be used to offset any activity. By keeping unrelated business activities separate for tax purposes, organizations can comply with IRS regulations, even though it may increase reporting complexity and potential tax liability. Properly managing and tracking each activity ensures accurate reporting and helps maintain the organization's tax-exempt status. To accurately report UBIT, you must first determine which activities are considered unrelated business activities that generate unrelated business income. Each activity should be evaluated separately to ensure proper reporting. Direct costs should be allocated to the specific unrelated business activity generating income. For example, if a nonprofit runs a coffee shop, all expenses directly related to running that coffee shop, such as supplies, salaries, and rent, should be reported under deductions for that activity. Then you allocate indirect costs based on a reasonable method, such as one of the following. Percentage of revenue, which is allocating based on the proportion of revenue each unrelated business activity generates. Time-based, which is allocating based on the time employees spend working on different activities. Or usage-based, which is allocating based on the use of shared resources like office space or utilities. It is important to allocate your costs accurately to ensure accurate reporting and compliance with IRS regulations. Also, proper allocation prevents unfair tax burdens and accurately reflects the true income and expenses of each unrelated business activity. The 990T is due on the 15th day of the 5th month after your organization's fiscal year end, like Cameron mentioned earlier. For an organization with a fiscal year ending on December 31st, Form 990T is due on May 15th of the following year, and if a nonprofit has a fiscal year ending on June 30, Form 990T would be due on November 15th. Organizations can request that 6-month extension by filing Form 8868, and that extension moves the due date to the 15th day of the 11th month after the fiscal year end. Keep in mind, though, that this only extends an organization's deadline to file, not your deadline to pay any taxes due. So if you anticipate owing tax with your 990T, you will want to send payment in with your extension. If Form 990T is filed late without an approved extension, the IRS may impose penalties. Penalties can be based on the amount of tax due and/or the length of delay. Tax-exempt organizations that expect to owe $1,000 or more in UBIT may be required to make estimated tax payments throughout the year. These payments are generally due on the 15th day of the 4th, 6th, 9th, and 12th month of the organization's fiscal year. In addition to federal filing requirements, check for any state-specific requirements or deadlines for unrelated business income tax. Functional expense allocation and UBIT are interconnected. When allocating expenses, it's crucial to separate expenses directly associated with unrelated business activities from those related to exempt purposes. This ensures that the costs attributable to unrelated business activities are accurately reported for UBIT purposes. Direct costs should be allocated directly to the unrelated business activity on Form 990T, but indirect costs must be allocated between exempt activities and unrelated business activities. This is usually done based on a reasonable allocation method, like the methods discussed earlier. These expenses are reported in their correct bucket on Part 9 of the main Form 990 based on the allocation method used. This ensures that only appropriate expenses are deducted from unrelated business income. Form 990 also requires clear reporting of all revenue sources, including unrelated business income. Accurate reporting on Form 990 and Form 990T reflects the true financial impact of unrelated business activities on your organization. By effectively managing UBIT and ensuring accurate reporting on Form 990T, nonprofit organizations can protect their tax-exempt status, demonstrate financial integrity, and continue to focus on their mission-driven activities. Proper handling of UBIT-related issues and detailed financial reporting are not just regulatory requirements, but also best practices that support the organization's long-term sustainability and credibility, all of which helps build trust with donors.
And our next polling question is, how many states do you file in? A, 1, B, 2 to 3, C, 4 to 5, or D, 6+ states? Again, how many states do you file in? A, 1, B, 2 to 3, C, 4 to 5, or D, 6+ states? Okay. We can move on to back to the presentation. Okay, a couple questions have come in to the chat. So the first question that came through is, how does the IRS define officer? And the IRS actually says that a person elected or appointed to manage the organization's daily operations. So they give examples as a president, a vice president, secretary, a treasurer, a CFO, we see that a lot, or a senior vice president of finance. Those are some titles that typically we see as being officers on the Part 7 of the return. The second part of that question is, does officer compensation include 401k plan contributions made by the employee? And the answer to that is yes, it does. The IRS actually, in its instructions, has a 3-page chart of what is includable in Part 7 and in Schedule J, and it specifies that employee contributions, because they are in the W-2, would be included on 990 as well. Okay. Another question that we have, let me just read through these, I apologize. The state of Ohio AG sent me a letter that we need to file our 990 by 5/15, but my accountant says we extended. Do I need to do anything? Jenna, do you want to take that one?
Jenna, I don't know if you're on mute, or Natasha, if you know the answer to that one.
I do know the answer to that one. So if you receive a letter saying that you need to file by 5/15, but you've already extended, the AG office actually accepts the federal extension 8868. So while you'll still get an email saying that your report is due, as long as you have that filed 8868, you can ignore that email. So there would be nothing to do there. Some other questions.
And what we can do while Natasha's kind of reviewing the questions here, I'm just going to throw the results of some of our earlier poll questions up. We do have one more final poll question, but I'll go ahead and throw those up while you're talking, Natasha. So feel free to kind of keep talking as these are going by on the screen.
Yeah. Someone else asked a good question regarding unrelated business income. And is it better to avoid any opportunities to gain income from unrelated business activities? Are these unappealing for donors to see in 990s? The answer to that is no, you do not need to avoid any opportunities to gain income. Gaining income for not-for-profits, I mean, it's always great to have more funds to work with to support the mission of the organization. You just have to be cognizant of what you're doing and how much unrelated business activity the organization is taking on. So if the unrelated business activities become more income than the grants or related income coming in, you really need to look at how the organization is structured, and maybe that unrelated business activity should be spun out into a separate entity. But it's never a bad thing to gain income for an organization to help support your mission. So I would say they are not unappealing for donors to see in 990s. Another one, what are the benefits of being listed on GuideStar, and would you recommend it? Are there other similar places as well? I think Jenna's microphone is back on, so if she wants to take that one.
One of the benefits of being listed in those public places is that when you are trying to reach potential donors, they can look at your 990 and see what your mission is. They can see what programs your money goes to. They can see your program percentage, so that they know that the money they're giving you is going to somewhere that they want to see the benefit come from. There are a few of them. We have Charity Navigator, ProPublica, GuideStar, and then the IRS also keeps a list of all your filed records, so that if somebody is deciding between Charity A and Charity B to give their money to, they can look at your 990 on those websites and decide which one they'd prefer their money to go to.
I think we have time for maybe one last question, if we have one, before our final poll question and before Allie wraps things up.
Okay, so one of the questions that came through is, if board members are not compensated, should they be included on line 6 as volunteers? And Cameron, you want to take that one?
Sure. The answer is yes. If there are board members that are not compensated, they would be included on line 6 as volunteers.